The bank doesn't make money for you. The bank makes money off you. The moment you truly grasp that, your entire relationship with capital changes forever. Most people spend 40 years handing their momentum to institutions and begging loan officers for permission to use their own money. Then they retire and wonder why the math never worked out. But the wealthy play a different game. They don't use the bank's ecosystem, they build their own. Think of your money like a river. In the traditional world, the bank is a dam that schemes off the top every time your paycheck or mortgage flows through it. The elite build their own dam to redirect that flow so the profits stay with them. This isn't about burying cash or chasing crypto, it's about private financial infrastructure. There are 3 legitimate, IRS-recognized ways to do this. These aren't loopholes or magic tricks. They are logic applied consistently to build extraordinary wealth. The first strategy is the one everyone gets wrong because of a massive reputation problem: overfunded permanent life insurance. Most people hear life insurance and roll their eyes, but they're thinking of the wrong product. Under Internal Revenue Code Section 7702, certain policies are allowed to grow and distribute money with incredible tax advantages. The wealthy take a permanent policy and overfund it. This excess money accumulates as cash value that grows tax-deferred or even tax-free. But here's the catch: they don't withdraw the money. They borrow against it. When you borrow against your cash value, the IRS doesn't count it as income, so the loan proceeds are tax-free. But it gets better. Your original money stays inside the policy and keeps growing as if you never touched it. This is real leverage. You could be earning 7% inside the policy while deploying that same capital into a real estate deal for 12%, all while only paying a 4% loan interest rate. You are winning on the spread. You become the bank, and when you pass away, the death benefit pays off the loan automatically. But you have to be careful. Most agents will try to sell you a high death benefit because it increases their commission. If you're using this as a banking tool, you want the exact opposite: maximum cash value and the minimum death benefit required by law. If your first-year surrender value is significantly lower than your deposit, that gap went to the agent, not your wealth. The second strategy involves the retirement account nobody thinks to borrow from. Most financial gurus tell you to put money in a 401k and never touch it for 40 years. That is incomplete advice because it ignores a tax-neutral mechanism that allows you to access capital without penalties. There is a massive difference between a withdrawal and a loan. A withdrawal triggers massive taxes and a 10% penalty. A loan is treated as a loan by the IRS. You can typically borrow up to $50,000 or 50% of your vested balance. You have 5 years to pay it back, and the interest rate is usually around 4.5%. Here is the secret: you pay that interest back to yourself. The bank earns nothing. You are taking $50,000 that was earning 10% and using it to wipe out credit card debt at 22%. You effectively gain 18 percentage points on that capital, and your future self gets paid the interest. This is a powerhouse move for solo entrepreneurs using a solo 401k, which allows for even higher contribution limits. The third tool is where things get genuinely sophisticated: private lending between your own business entities. If you own an LLC or an S-corp, you can create a private lending relationship where your safe entity lends money to your active entity. Instead of paying a bank 5% interest, your business pays that interest to your other LLC. The borrowing business gets a tax deduction for the interest expense, and the lending business keeps the income. The money never leaves your universe. This also acts as a massive asset protection shield. By using a safe, anonymous LLC in a state like Wyoming to lend to your active deals, you separate your capital from the risk. If a deal fails, your safe entity is a secured creditor with priority over everyone else. You aren't just an owner, you are the lender. The IRS will watch this closely, so you can't just move money on a whim. You need a signed promissory note, a real repayment schedule, and an interest rate at or above the federal applicable rate. If you don't follow the book, the IRS will call it a disguised distribution and tax you accordingly. Beyond these three, the wealthy also utilize tools like the HELOC and the S-BLOC. Most people treat a home equity line of credit as emergency-only cash. The elite use it for investment because that interest can often be deducted as an investment expense. The S-BLOC, or securities-backed line of credit, is even more powerful for those with large stock portfolios. You borrow against your stocks at low rates without selling your positions. This means your portfolio keeps compounding while you use the credit line to make cash offers on real estate or businesses. It allows for massive acquisitions without ever stepping into a bank's loan committee. The fundamental principle here is simple: capital is most powerful when it is circulating, not sitting. Every dollar you leave idle in a low-interest savings account while paying high-interest debt is a dollar you are losing. Every time you borrow from a stranger instead of yourself, you give away a piece of your financial future. The wealthy don't have access to different assets than you, they have access to different knowledge. They understand which tax codes protect them and how to make $1 serve multiple purposes at once. But these strategies come with real risks if misused. Life insurance is a decade-long commitment. If you bail early, you lose. 401k loans must be repaid if you leave your job, or they become taxable events. Related party lending requires strict documentation to avoid IRS scrutiny. HELOCs put your home at risk, and S-BLOCs carry the danger of margin calls in a volatile market. The quality of your financial life is determined by the quality of your understanding. Most people outsource that understanding to the very institutions that profit from their ignorance. Banks profit when you don't know how to self-finance. Insurance companies profit when you buy the wrong policy. You now have the knowledge to stop being the bank's profit center and start being your own. It requires discipline and professional guidance, but the tools are well established and legally sound. The gap between you and the elite isn't talent, it's knowledge applied with patience. Think carefully, move deliberately, and make your capital work as hard as you do. And that's the game the wealthy have been playing for decades, and now you know the rules too. If this video opened your eyes, do one thing right now: hit that subscribe button. Because every week I break down the exact strategies the top 1% use to build wealth, and I don't want you to miss a single one. Drop a comment below and tell me, which of these 3 strategies are you going to implement first? The life insurance hack, the 401k loan, or the private lending system? Let me know, I read every single comment. And if you found this valuable, share it with one person in your life who needs to hear this. Because the gap between financial freedom and financial struggle is just knowledge, and you just got a little closer. I'll see you in the next one. Stay building.